All right, welcome to The Explainer. Today, we're going to break down how to analyze any stock with a really simple three-signal check. Seriously, this is the method that'll help you stop just taking tips and start making your own confident decisions as an investor. So, let's start with something I'm sure a lot of you have felt. That frustration, right? You hear about some hot stock, you get excited, you jump in, and poof, it goes nowhere. So many people get burned just following random advice. But what if you could actually make your own calls with real confidence? Well, let's get into exactly how you can do that. Okay, this right here, this is the #1 mindset shift you have to make. It's the secret sauce. You've got to stop staring at those daily squiggles on the price chart. The real key, it's just common sense. You need to look at what actually matters, the health of the business behind the stock. Ask yourself, am I buying a piece of a great company, or am I just gambling on a ticker symbol? So, first things first, we have to change our whole approach here. We're going to move away from just speculating and get into the world of real analysis. You know, it's kind of funny. The source material for this brings up a great point. Common sense just isn't that common when it comes to the stock market. Most people lose money simply because they ignore the basics of the business. But we're not going to do that. By just focusing on a few key fundamentals, you're going to have a huge advantage over almost everyone else. So how do we actually do that? Well, let's get to the good part, the solution. We're going to use this super simple, really memorable framework. It's called the 3 green signals, and you can use it to check out any company, no matter how big or small. And this is it, the whole framework. Seriously, that's it. Just 3 simple checks that tell you pretty much everything you need to know about a company's financial health. It's so simple, but so effective. Okay, let's break down each one. Okay, signal number 1, the income check. The question we're asking is simple. Is the company making more money over time? I mean, it sounds super obvious, right? But a business that isn't profitable and isn't growing those profits, well, it's not going to be around for long. And eventually, the stock price catches up to that reality. All right, next up is the balance sheet check. This is all about financial stability. Just think about it like this. Does the company own way more than it owes? A company with tons of assets and very little debt is like a person with a great big emergency fund. It's just less risky, right? It can handle the tough times. We're looking for that safety cushion. And finally, signal number 3, the cash flow check. Is the company generating real cash? Look, profit on a spreadsheet is one thing, but cash is king. Cash is what you use to pay your employees, pay your bills, and grow the business. Without it, you're in trouble. So this is the really crucial part. You need all 3 of these signals to be green. Not 1, not 2, but all 3. Okay, so that's the theory. Sounds good, right? But how does it actually work in the real world? Let's put this whole framework to the test. We'll take a look at a massive company that I'm sure a lot of you know, Hindustan Unilever. So let's start with signal number 1. We're putting on our analyst hats and doing the income check. Is this company actually making more money over time? Let's see. Wow, okay, just look at these numbers. The trend here is crystal clear. From 2012 to 2021, revenue more than doubled, jumping from 23,000 crores to over 50,000. And even better, look at the net income, the actual profit. It nearly tripled. That is one heck of a growth story. Yeah, so that one's a no-brainer. That is a big, flashing green signal. This company has a proven track record of growing its business and its profits. So, check number 1, passed with flying colors. All right, 1 green light is great, but remember the rule. We need all 3. So now it's time for the other 2 checks. What's the deal with its balance sheet and its cash situation? Let's find out. And again, the numbers tell the story. Look at this. They've got about 20,000 crores in assets, but only 12,000 in liabilities. That's a really strong financial cushion. And on top of that, cash flow is positive and it's growing. I mean, this just screams financially solid company. So, boom, that's 2 more green signals right there. Okay, so the system works great on a big, stable, giant like Hull. But here's the ultimate test, right? Can it help us sort through smaller, less-known companies? Let's compare two of them and see if this method can spot a winner and maybe help us dodge a bullet.
Okay, this slide says it all. On one side, you've got Burger King India. And yikes, it's showing some major red flags. I mean, it's consistently losing money, its debts are really high compared to what it owns, and it's just burning through cash. Now look at the other side. KE Industries. It's a completely different story. Growing profits, a super strong balance sheet, assets are almost double its liabilities, and solid positive cash flow. The difference is just night and day.
But this brings us to the big question, right? The one that really matters. Does any of this stuff, the income, the balance sheet, the cash, does it actually affect the stock price in the long run? Does it translate into real returns for investors? Well, according to the source material, the answer is a huge resounding yes. The company with the 3 green signals, KEI Industries, went on to deliver over 6x returns for investors, an incredible performance. Meanwhile, Burger King, with all its IPO hype but weak fundamentals, actually lost investors money after that initial buzz wore off. So, what's the big lesson here? What do we take away from all this? It's about more than just a simple checklist, you know? It's about developing a whole new mindset as an investor. Because when you know the company you've invested in is strong, you just don't panic. You don't get shaken out by scary headlines or random price drops. Why? Because you know what you own. You're invested in the business, not just gambling on the price. You have a deep down confidence that over the long term, its true value will shine through. So let's wrap this all up. What are the key takeaways? First, stop chasing stock tips and start analyzing the actual business. Second, use the 3 green signals, income, balance sheet, cash, as your go-to checklist. Remember that strong fundamentals almost always lead to strong long-term performance. And finally, this is how you start investing with real confidence, not fear.
So I'll leave you with this one last question to think about. Are you just betting on a price, or are you actually investing in a business? How you answer that, well, that's going to define your whole journey as an investor. Thanks for watching.